Welcome to Global and Media Stocks to Watch. I'm Michael Swido. We have a very special edition today, looking at one of the fastest growing sectors of the stock market in Singapore, which in turn is one of Asia's most important financial markets. There have been a dearth of new stock listings on the Singapore Stock Exchange, and a lot of hand-wringing to figure out what to do about it. But that is a topic for another day. Today we take a look at a contrasting sector, one that has nearly doubled in size over the past few years, and which has enjoyed some 20 new listings. I'm talking about exchange-traded funds. And joining me now to take a deep dive into the sector are SGX market strategist Geoff Howie and his colleague Wei Chin, who is a SGX Director of Securities Trading. Gentlemen, great to see you both. Thanks for joining me today.
Morning, Michael.
Morning, Mike.
All right, Geoff, the contrast between new stock listings and ETFs in Singapore is stark. Why do you think the ETF sector is thriving? Why is it growing in Singapore?
Michael, there are a number of reasons. I think demand and supply are both factors that are creating the buzz in this market. You've had, as you said, 20 ETFs list here across a number of asset classes. Many of the underlying indices that are being tracked by the ETFs are very popular with investors, whether it's the new investment themes or overlays with a lot of economic relevance to our region. There's a lot of interest in it. That creates the demand. At the same time, we're able to leverage off the distribution channels and engagement forums that we have at SGX in order to build the interest and the participation across both institutional and retail investors. Having a marketplace that very much wants to find efficient ways to have market exposure. From a supply side, you've got a product that is relatively less expensive than traditional mutual funds. So that's been a big factor in the growth of ETFs globally, and that's obviously very much relevant to the growth we're seeing here in Singapore as well, that fee aspect. Also, as I said, the engagement and the education that we've been able to basically implement with the rollout of these new ETFs have also, to an extent, made it somewhat fun. So, of course, it's a market. You have risks, you have potential returns, but at the same time, we've taken the opportunity with the role of these ETFs to also get to know and understand our customers better, be it retail or institutional investors, and keep tweaking and finding the right ETFs to roll out that can actually, in a way, really be demand driven.
All right, well, there are currently 46 ETFs listed in Singapore. They have a combined assets under management of approximately $8.5 billion US. Wei Chin, can you give us a sense of the different types of ETFs that are available?
Yep, sure. So today we have a pretty diverse mix of asset classes across fixed income, equities, REIT, and gold. Allocation-wise, it's about 40% into equities, 40% in fixed income, and 20% among REITs and gold ETFs. The growth from these asset classes has been pretty strong, especially for the non-equities ones, namely fixed income and REIT ETFs. Over the last 5 years, they have grown in multiple folds. In fact, the REIT ETF recently has reached its historical high in AUM, closing into $1 billion in asset size itself. So we are seeing investors demanding for more of such multi-asset choices, so that they not only to invest into a particular stock market, they are also using ETFs to make their portfolio more diversified in terms of the exposure to various underlying asset classes.
It's interesting to note there are several superlatives when it comes to ETFs in Singapore. Take fixed income, for example. Singapore is home to both the largest Chinese government bond ETF, as well as the largest US dollar high yield bond ETF. And perhaps that highlights Singapore's close links to the world's two largest economies. There are also ETFs that track other Asian markets, including India, Indonesia, Japan, Vietnam. But I'll tell you, when I was looking at the list, another thing struck me as well, and that's the number of sustainability-linked products. There are half a dozen ETFs that have low carbon or climate in their name. The best performing of them, and these are a mouthful, are the iShares MSCI India Climate Transition ETF, and the Lion-OCBC Securities Singapore Low Carbon Index ETF. Don't worry, we'll put the stock tickers up on the screen. Both of these are up about 15% so far this year. Geoff, what sort of stocks do these ETFs hold, and why do you think they're doing so well?
Basically, how they do so well, there is a sustainability tilt, but generally you'll find the parent indices that don't have the sustainability tilt are also doing well. Because when we're looking to list the sustainable linked ETF, you obviously need to find a parent that is generating the returns that are basically going to make the investors happy and the same risk profiles and whatever. So if you look at that India ETF we were talking about that MSCI have built, you're looking at selecting companies that go through a filtering process that have a tilt in way that they're generating less greenhouse gas emissions, generating less carbon, CO2, and you want to find also, I think there's a tilt as well where you want to have fossil fuel reserves 30% less than the going rate, if that makes sense. So having those tilts are really important. And then those companies that have more progress, made more inroads into not just their reporting, but reducing their carbon emissions and greenhouse gas emissions. You basically, or using less energy, less water, for instance, they will find their way to have a bigger weight in the index. So you still got the sort of same universe of stocks. And you're just basically, in most cases, reweighing according to the progress made in the companies achieving their carbon zero goals. If you want to take one example of a company, Reliance Industries, I think, is the biggest weight of the MSCI India Sustainable ETF, and it has a net carbon zero goal by 2035. So while it is known as an energy provider, it's also maintains that it's providing modular, large-scale, affordable, and modern green energy businesses in order to achieve that 2035 carbon zero goal.
All right, so Reliance Industry, an example of a stock that's inside these ETFs. And these ETFs, it seems, they're for investors who both want a good return because they're up 15% or more this year, but also who want to invest in something that is good, that is sustainable.
And obviously, risk management's a big part of the game. You also always have that transition risk, remember, as the world does move towards carbon zero, new carbon zero world. You've obviously got investors that want to basically reduce their risks to those companies that won't be at the same part of the curve as those companies that are reducing their carbon.
All right, good point. I also want to point out that there are a lot of commodity investors who watch the Stocks to Watch channel. So I want to point out that the best performing ETF in Singapore this year to date is the Spider Gold Shares ETF. It's one of the world's largest gold ETFs, and it's up more than 20% since January. The Spider Gold ETF is cross-listed in several markets, but Singapore is the biggest one outside the United States. All right, let's talk REITs now. Wei Chin, you mentioned them earlier. The Singapore market is well known for its real estate investment trusts. Historically, investors have tended to buy REITs for their dividend yields. There are several REIT ETFs listed in Singapore. Geoff, what can you tell us about them?
There's a handful of them here, Michael, that are tracking what has become a very important asset, I guess, for investors, not just in Singapore, but across Asia, as we're seeing more and more countries embrace the real estate investment trust model in Asia and roll them out. It's a huge part of our stock market. So almost 20 cents in every dollar that changes hands in our stock market is in the real estate investment trust market. It's been growing significantly for the last 20 years, just like the ETFs has been growing. But finally, we've been able to bring the two together and have ETFs that track the REITs. So for investors that are looking for the yield, as you mentioned, and our iEdge SREIT index generally yields around 6%, which at the moment is something like 3% higher or 300 basis points higher than the MAS 10-year government bond. What they can do is, rather than taking a bundle or a basket of ETFs themselves, they can obviously track that index, which is basically built on the biggest the biggest REITs that we have in our sector. And by tracking that index, it just becomes, as we say, a very efficient way to invest, because rather than paying the transaction costs on, let's say, 5 to 10 ETFs, 5 to 10 REITs, you can just basically pay the one transaction cost on the one ETF that is built on the actual REIT index and all the constituents. And as we say, that those constituents, when you weigh them in the way that the index is actually weighed, according to the free float market capitalization, they're actually distributing around a 6% yield. At the same time, they've been very interest rate sensitive. So with all the fluid outlook for inflation and now growth this year, we're seeing an element of tradability in the REITs as well. And by using the REIT ETF as a tradable forum for the actual REITs is also quite efficient when you think, okay, you can quickly have access or exposure to the whole sector, again, in one transaction, and therefore basically optimize your transaction costs when you're taking exposure. The REIT sector as a whole, it has basically been weighed by the higher interest rates. The higher interest rates increase the financing costs for the REITs, which in turn reduce the distributable income that the REITs can distribute, and therefore reduces the yield of the REITs. And that's why they've all been priced lower, most of them, since the end of 2019. But the sector is really taking a lot of spotlight and a lot of interest right now, obviously ahead of the FOMC meetings on SEP 18, November 7, and DEC 18.
Yeah, I mean, the REIT sector, as you say, it's been underperforming with companies suffering from those high interest rate payments. But with rates set to drop both in September and moving forward, some say that sector is ripe for a rally. Wei Chin, do you want to add on anything about the REIT sector?
Yeah, just 2 points to add on. Jeff mentioned about the tradability. So besides the lower transaction costs, because you just pay one-off brokerage fees to enter into an ETF with a basket of REITs, if you compare the bid-ask spreads, so for those who are spread sensitive in terms of trading listed securities, the ETFs itself also represent a more than 50% reduction in the bid-ask spreads that you are seeing when you compare to an average weighted basket spreads of the underlying constituents. So besides a one-off transaction cost, the total spreads you're paying are also reduced, just because it has become today a more liquid instrument for investors to gain direct access to the REIT market. Second point is also on the volatilities. So even though REIT has proven to be more stable in terms of its price movement compared to other majors, compared to per se equities per se, when you go into a REIT ETFs, because you're buying to a broad base underlying of REITs, including commercial, logistic, hospitality, you will see a much lower volatility nature compared to when you buy into an ETF itself. So for investors who prefer to have a much lower vol in terms of their REIT exposure, REIT ETFs could be something that is useful for them to think about.
Okay, so lower cost, lower volatility, good to know. Also, it's worth noting that some of the biggest names in finance are behind the Singapore ETF market. These include BlackRock, Nikko Asset Management, and State Street Global Advisors. All right, so those are some of the institutions. I want to look at things now from an investor's viewpoint. Wei Chin, how liquid is the market? Is it easy to buy and sell these ETFs?
So on SGX, we do have a few supportive measures in terms of enhancing liquidity for investors. Most importantly, we do have a designated market maker scheme in place, meaning that all ETFs that are listed on SGX are mandated by regulations to have at least one designated market makers. And their role is to provide intraday liquidity by ensuring that investors can get in and out at all times, as long as the stock market is open. So that has ensured that investors who have a vested interest or who are looking to invest into the ETFs has easy and has confidence to be able to make that trade on the exchange.
Okay, and to be clear, the market is open to investors across the globe. You don't have to be in Singapore to invest. Is that correct?
That's correct. So as long as the investor have access to SGX through their brokers, they can trade on the ETFs, be it in Singapore, in the region, or global.
Okay, good to know. If we look forward now, I'm curious what you all think are the biggest trends when it comes to ETFs, what we should be looking out for. Geoff, I'll let you go first.
Okay, the first one, Michael, is clearly more active ETFs, and we've launched our first actively managed ETF at the beginning of the year. This makes sense as we get more sophisticated in our digital capabilities, and this is where AI also comes in and helps. We can be basically reweighing those constituents on a much more active basis. Obviously, let's say a stock constituent of an index, assume it's just two stocks in an index. You'll never have that, but this is just for the example. You have one stock that really outpaces the other, and that one stock, obviously, that is outpacing has a much bigger weight. Now, what you might want to do is look at some of the metrics, whether it's valuations, whether it's financials, whether it's quantitative type of momentum metrics that are potentially were the drivers of that stock to outpace the other. Now, identifying those metrics quickly before or at the same time that you see the price actually respond to those metrics is a way to increase, I guess, the weighings, increase the weighings in a more efficient manner. Basically, being able to identify the leaders of the index versus the laggards of the index on a much more, I guess, quicker real-time basis, if that makes sense. So that's one aspect of active ETFs that I think is really important, really interesting. Generally, that you pay a little bit more because every ETF does have a management fee per se. So your total expense ratio, as you can imagine, would be a little bit more for an actively managed, hopefully actively traded ETF than a passive ETF such as the gold one that you mentioned before, which I think has a total expense ratio of around 0.4% per annum. So that's one aspect. I think catering, being able to have more ETFs that cater to different investor risk profiles is also really important. I think we've had a couple of leveraged ETFs launch. There's a lot of leveraged products there. So if you have a risk profile that is quite experienced, very well educated, quite sophisticated, you might want to up the ante a little bit, have a little bit more exposure to bigger swings in the course of the day. And for that reason, you see the leveraged ETFs also take off. And then, of course, why not have an ETF on ETFs? Diversification has become important, but then selective diversification is also important as well. So one day, who's to say you can't say, okay, my ETF is going to be on these 5 ETFs that I choose, and I press the one button, and instead of paying the 5 transaction fees, pay the 1 transaction fee. The great thing is the industry, I think, is booming when you look at assets under management. And as we say, there's a demand for it, but there's also supply moving with that demand. And it's also moving in a way that because of technology and digitalization, the ETFs are not getting more expensive. In fact, they're getting less expensive, particularly, as we said, in comparison to the price of mutual funds and whatnot. ETFs, they're not free, of course. You have to pay transaction costs to enter, to exit, and you have to pay your total expense ratio, which comes out of the distributions or comes out of the price performance on an annual basis.
All right, really good to know. I love that idea of an ETF of ETFs. I mean, in the US, with the elections, you talk about the poll of polls, and look at all the polls and try and put them together. And so let's have an ETF of ETFs. Wei Chin, what about you? What's on your radar?
Besides active ETF, which I fully agree with Geoff, is growing strongly globally in terms of the number of new launches. So that is certainly something we are working very closely with our issuers. Since the guidelines has been published earlier this year, we are in talks with a few other issuers to launch more wider range of active ETFs to serve the investors. Active ETF aside, fixed income, that's probably the next big thing that globally as well as in the region in Singapore has seen a lot of adoption growth. We used to cover mainly Singapore and Asia bonds. So recently in 2020, we launched the first Chinese government bond ETFs. So before that happens, investors will have much limited options. if they want to gain exposure into China RMB bonds, and certainly not on a real-time basis. With intraday liquidity, ability to get in and out, react faster to the news coming from China. And this has made possible now with the launch of the Chinese government bond ETFs. Next thing is also on the more diversified kind of bond exposure. We are talking about credit markets. If you do want to have exposure to the entire Asia high yield market, it's very tough for you to ask for quotes and for you to execute one bond by one each individual issuance by issuance. But with the ETFs, you can get diversified exposure into all sectors, into all countries in Asia, with one single ETF. So I think these are the bond ETF is certainly the next big thing, or rather it is currently the big thing that is growing globally and in Singapore.
Okay, so I think that's great advice, particularly for international investors interested in Asia. If you're looking for good exposure to the region, then looking at these bond ETFs that span the region, that span Asia, that are listed here in Singapore, that's a good way to go. Before I let you all go, Geoff, one last question for you. What advice do you have for viewers who might now be thinking about investing in ETFs in Singapore, particularly for the first time?
That's easy. Education. Look, it's a product that has some unique characteristics. For that reason, you don't have to worry. You don't have to sweat about reading a 100-page product disclosure form, although obviously that's good to do. But we can also help educate and point out how they work, what the differences are, in a more interactive way that might make the investors help to conceptualize the objective of ETFs, the risks of ETFs, and so forth. So I guess what I'm trying to say is we can really help a lot. We have something like 300 seminars a year that is based on education, and obviously a lot of that is focused on the product side of the stock market as well, which includes ETFs. So the big advice is, I think most people can get it, that investing in an index will always trump investing in a stock, to an extent that if you look at the risks that come with a stock, Kodak, for instance, can be disrupted. An index, very difficult to be disrupted, because the index should always take into account the most actively traded and the largest stocks by value for that particular segment of the market that it's tracking. And therefore, this is the interesting thing, right? We've got 30 Singapore stocks in our STI at the moment. Who knows what 30 stocks will be in the STI in 30 years' time? And you can be a part of that journey from today by investing in that STI ETF, and who knows what your ETF will look like in 30 years' time. But you will, if the STI rules stay the same, have 30 of the best Singapore stocks, or the largest and the most actively traded.
Yeah, exchange trade funds, they definitely offer that more diversified approach to investing. The fees are often lower as well. And what we're hearing is that the market here in Singapore has a very interesting mix of these: gold, Asian equities, U.S. fixed income, real estate investment trusts, much, much more. Gentlemen, thank you so much for giving us an overview of the market.
Thank you, Michael.
Thank you.
We've been speaking with Geoff Howie and Wei Chin of the Singapore Exchange, which, by the way, is also a publicly listed company. And you've been watching Global One Media's Stocks to Watch. I'm Michael Swido.